I'm Charlotte McLeod with investingnews.com, and here today with me is Omar Ayales, who writes the Gold Charts Are Us newsletter. Thank you so much for being here. Great to see you.
Great to see you, and thank you, Charlotte.
Yeah, really good to be finally connecting with you. We were talking before we turned the camera on about how I've seen you around conferences for years, so really good to finally connect. I thought just since it's our first time speaking, I know many of our audience members will probably be familiar with you, but if you could just start by giving a brief overview of your background and the work that you do.
Absolutely. I currently write a letter called Gold Charts for Us. We analyze the price movement of bonds, stocks, and equities, broadly speaking, commodities, broadly speaking. And we specialize in gold, like our letter says, the Gold Charts for Us. And I've been writing this letter for 13 years, and I'm a corporate lawyer from background, and especially in corporate finance. So which allows me to understand some of what's happening in the business, the miners, and from that perspective. And we try to analyze the macroeconomic trends and try to make some sense out of them, and try to establish primary trends to provide investors and traders a good path as to how they can be basing their investment strategies and building up their portfolios.
Okay, really great overview there. So let's jump in and start talking about what's going on with gold right now. So just before, as I was getting ready for this interview, I was reading a recent piece that you wrote where you're talking about the 7-year cycle in gold. And if I understand correctly, essentially it's saying that every 7 or 8 years, gold hits a low, then we set up for a move higher. So I was hoping you could situate us in terms of where we're at in that cycle right now, because I think that would be really helpful for investors.
Absolutely. Yeah, definitely. Gold is cyclical. I think like many people understand and see it this way. But we have at Gold Charts for Us, we have in identifying long-term trends and looking at primary trends and always trying to identify, where is the primary movement towards. And we have identified, like you correctly say, a 7-year cycle, 7 to 8 year cycle. It's a 7-year cycle when it's in a bull market, gold, and it's an 8-year cycle when it's in a bear market. That's why it's 7 or 8. But basically, if you take the price of gold since 1970, okay, which was around the time that the market was open, and it was started to be trading freely, okay, every 7 to 8 years, you see that basically gold formed the major bottom. Okay, and that doesn't necessarily mean that the future bottom is going to be lower, okay, than the previous bottom. It's just a major bottom that usually precedes a major then a up move. And if you actually go 7 to 8 years, you will easily find these mega lows within the past 40 plus years. And more recently we had one of the most major lows, and I think it's easy to identify, was back in 2008-9, and another one was in 2015. 2015 was a major low. I don't know if you remember. I'm sure that many of the viewers are going to remember that. Back then, gold had peaked in 2011, 2012, went into a very crude, bear market, where it was tough for many, and gold, retraced lots. And it actually bottomed in December of 2015. Coincidentally, 7 years after the previous low, 2008-9. The other major low after that, of course, was last year, 2022. And it's not a coincidence, Charlotte, that this major low, 2022, also coincided with a breakout in longer term U.S. Treasury yields. And we'll get that in a minute. I don't want to maybe necessarily confuse the situation, but they do correlate, and it is important, and because it validates gold's move. But what this cycle is telling us is that not only that gold reaches a bottom every 7 years, but after it reaches a bottom, it goes on to reach an 11-year uptrend and to reach a high. So in every bottom precedes an 11-year move. So, for example, the last 11-year move that we saw, gold peaked in 2020, and that was from the low of 2008, 2009. the low of 2015, we believe that is going to basically the 11-year cycle on the top of that, will peak in 2026, 2027. And then, talking further, the 11-year after 2022, that's already like, maybe a little too far out, but, 2032, 2034, 2033, right? But what this suggests, okay, and if you're looking at the chart and and if you're looking at the major lows, what this is telling us is that basically the major low from now to 2026, 2027, we've already seen, and it was last year. Now that doesn't mean that those lows cannot be retested. It just means that it's very unlikely for them to be broken. Okay, so actually, for this the current down move right before this up move, okay, we believe that gold was actually going to fall a little bit below the 1800 level and probably even retest those 2022 lows. And, to our surprise, it didn't. It actually held, which tells us that, overall, in the bigger scheme of things, gold is very strong. Okay. And it's a very strong cyclical moment and a mega trend. And, so, of course, and, it's not, again, like things won't, gold won't rise in a linear way 2026, 2027. It's not going to just, make that jump like that. There will be pullbacks. There will be secondary reactions. I am a trader as well, so I don't believe that you just buy anytime blindly. I like to buy. I like the contrarian view. I like to buy when everybody's selling, and I like to sell when everybody's buying. And so, but if you're a longer term investor, and you're not really looking at time, and you're not paying attention too much as to where the price of gold is right now, of course it's a great time to buy. It's a great time to buy because over the next few years you are going to see higher gold, even though we might get a pullback here and there.
Okay, I think that gives us a really good overview of the big picture for gold. And I was going to next hone in on kind of what's going on right now, because it's an interesting day for gold, because we did have it past the 2000 per ounce mark. I don't know if it's still there. I think it might have pulled back a little, or maybe it's still there, but we're hovering at least right around that level. And this is a point that people really get excited about. We've seen gold at this level, above this level earlier this year, but it's pulled back. So at this point, is this the time, do you think, where we get here and we stay here? Or how does that look to you, given everything that you've been talking about?
Well, look, and actually, gold does have a major resistance at around 2075. That was basically, it just, broadly speaking, that was the peak in 2020. And that was the peak in, I believe it was in 2022. And, and right now, like we could see that level be tested on the current up move that we're experiencing today. A big level, so to be able to go and retest that level was to break the $2,000 level, which, today, I believe it, yeah, like you're saying, it broke above it earlier in the day, and then I think it closed above 2,000 anyway. But, there is, you can tell that there's price resistance at that level as well. So, but going back to that triple top resistance, that gold at 2075, with gold major tops at those levels, it's a strong resistance, and technically speaking, price wise, gold will have to break above that level, to rise higher, obviously. Okay. And that resistance, will gold break it out on this up move? Or maybe not. Maybe it reaches 2075. Maybe it pulls back to below, to around the 1900 level before it makes another up move. That is very possible. Can it break it on this up move? Given what's happening around the world, Charlotte, I cannot see how it couldn't. Yeah, so I am overall very bullish for gold, and and it will break, to new highs. It's a question of, will it happen over the next month or two, or will it happen in 6 to 9 months? But I think it will happen.
Right. Okay. So we've got that resistance, as you said, at 2075. We don't know if we're going to break it this time, but it's going to happen in the future. Could you just briefly outline, where's the support for gold right now? Where are you seeing that?
Well, I have a short-term support at 1925. So, if gold, if you see gold around 1950, 1925, that would have been a great time. That's a good time to start buying. There's more of an intermediate support around 1800. And then if you go down to say that 2022 low, which that would be like, I guess, a mega support if, if gold would come to crash, which again, I don't see a fundamental for that, but, but you still have to keep all the options open. That's around 1700, 1675. And now I don't really expect gold to fall that far, but that is a major level that we keep an eye on. But for now, 1925, I think, is probably the more relevant level to be looking at.
Okay, so I think this gives us a good idea what's going on with the gold price right now. So if we pull back and we look at some of these macro factors that you've started alluding to, one thing I wanted to go over with you was the work you've done looking at interest rates. So in the piece I was reading that you did, you're talking about a big shift in interest rates into a higher for longer kind of period. And a much higher for longer period than people probably want to hear about. I think you're looking at 30 to 40 years of this higher rate environment. So I was hoping you could break that down. I think that's not probably news that people want to hear because we're already hurting from these higher rates.
Well, yeah, but there's a couple of things, Charlotte, I think, a lot of people are hurting because of, how the 500 basis points in 1 year, so I think, from 0 to 500 basis points or, 5%, I think that is very intense. And I think really that's what maybe is hurting people. But you have to realize, like, or try to understand that over history, over thousands of years of history, probably the average rate of return is about 5%. Just that the past 10, 15 years, since financial crisis, we've been used to a ZERP environment, right? And anything that is above that seems like a lot. But this major cycle that you're asking about, like this is one of the major charts that I look at that will define my primary trend investing in anything, not only in gold. This applies for pretty much everything. And I'll go into it in a second. Basically, the chart that I look at is the yield on a 30-year U.S. Treasury bond. Okay, so basically the yield on a U.S. Treasury bond, for me, tracks very well long-term inflation expectations. The bonds, the yields rise, of course, as bonds sell, and they basically are trying to capture the rise of inflation, longer-term expectations of inflation. Okay, and so this treasury, the treasury market, the longer-term treasury market moves in secular shifts of, like you were saying, 30 to 40 years. This means that a whole, from bottom to peak will take around 30, 40 years, and same from peak to bottom. So the last time, the last mega market in treasuries, actually was was the past 40 years. Back in 1981, the 30-year yield, longer term U.S. treasuries peaked at around 15% or a little bit higher, and that was in 1981. And basically 40 years later, went to zero, and then, it's starting to pick up. And of course, that not in a linear way, but, like downtrending, and over the course of time. In 2022, the treasury yield, the 30-year treasury yield coincidentally broke above, a mega resistance, a 40-year resistance, and it has held above it for the past year or so and kept on rising. This year it kept on rising. And, basically that mega shift, that breakout, basically tells me that the 40-year bond market, the bull market in bonds, or, bear market in treasury and bond yields, okay, it came to an end. It came to an end in 2022. And, sometimes, the deflationists, people say, well, are you saying is this time different? Those are the most, the four most dangerous words that you can ever say. I was like, well, and then when my response is, Charlotte, is if you're comparing to the past 40 years, yes, this time is different. But if you're comparing to the past 100 years, this time is not different. This has happened before. And, if you look at a 100 and, a long-term chart of the U.S. Treasury yield, you will see that from 1940 to 1980, yields rose. It was a secular bear market in U.S. Treasuries, a secular bull market in Treasury yields that went from the very lows, in the low single digits, and it peaked at 15%. And then at that moment, it started falling. It broke below this trend, and then it went on a secular bear market until it bottomed throughout the 2010s, and until it reached a full bottom in 2022, and it broke out from that bottom. 2020, and then it broke out in 2022 from that bottom. So on that on that premise, if you look at the chart, well, we've just started a new bull market in treasury yields. It's going to last 30 to 40 years by historic standards. Again, yes, it's different from the past 40 years, but it's not different compared to the past 100 years. It's actually very much the same. This has been there before. Now, it might not be convenient. Like you say, people are scared. A lot of businesses, a lot of, for example, like businesses looking for funding to fund new ideas and things. It's very different when you get a loan at a zero rate interest and, you speculate on a business venture. And it's very different if you have to pay, a 7-8% rate on that. Then you might not be so so happy to take risk because it's really going to cost you. It doesn't come, the risk doesn't come free then. And, I feel that maybe what happens is moving forward, once people, and start to get more used to the fact that, this is going to be a higher for longer, which, I think like, especially in the past several months, 3 to 6 months, I've seen a change in the narrative, like in news and, in financial media and, in mainstream financial media. It's everybody's now talking more higher for longer. It's becoming more mainstream, and I think that is just people coming to terms with the idea that, like it's a reality, and, like what's going to happen most likely, like, yes, maybe those, like the ultra speculative investor, maybe, that's going to scale down a little. Okay. Because now, it's a cost. Money is not so easily available. Okay. And, so those are going to be realities. Things are going to be better planned out, and not only that, Charlotte, something very interesting happens, most people have been used to short, the past 5-10 years, short-term investments. They want a short return. I want to make my money this year. I don't want to wait 10 years. I want now. I don't know what's going to happen in 10 years. There has been such an uncertainty over the long term regarding, all these economic phenomena that people have just been investors and, people have been just, they just don't want to go there. But that's going to change. That's going to change because now, we have higher financing costs. Now that we have, we will need, more time to be able to recuperate our investments, to be able to, turn a profit and to be able to do good business. And I think it's just getting used to it. And, people will get used to it. 30, 40 years, people will get used to it.
Right, right. So it's just about, how far back you pull to see the larger picture. Really interesting. So one thing I want to ask you about, so higher for longer interest rates, that's very clear how you've laid it out. Typically though, and this is not necessarily true, but typically we hear higher interest rates are not good for gold. And yet, so we're going into this higher interest rate period where also it looks like we're going to have a higher gold price. So I wondered if you could unpack that, explain what's going on there.
Well, it's actually very interesting because, gold and bonds, have not, I guess the reason for the question is because, from the year 2000 to, 2020, 2022, actually, in gold and bonds have moved and treasuries have moved together on a safe haven bid. Okay. So they both moved very much together. There's a chart. It's very, very, very well correlated. And for many years, our investment, on our letter was, like, these are the safe havens, they're going up, that gold is going up. But that has not always been the case. Before 2020, gold actually moved with yields, not with the bond. Okay, so for example, like from 1980 to the year 2000, when there was that decline in yields, there was a huge bear market for gold, even though bonds were doing well. It was a huge bear market for gold, and gold fell together with treasury yields. It was only until 2000, okay, that shifted, and then gold started to move with treasuries on a safe haven bid, given, I think, the money printing phenomena, because really it started during the Greenspan era, and it really got more intensified, like to Powell, right? But it really, that's where it started, and I believe that the shifts back then in gold, moving away from trading parallel with the yield and then moving with the bond is because all of a sudden I believe that, first gold got to be way too cheap, and then it also, it started to trade more of as a safe haven, and not too much with inflation. But traditionally gold moves with inflation and interest rates move with inflation. Inflation rises, interest rates catch up, gold rises as well. So not always on the same day, not always on the same breath, and not always, it doesn't always happen. Many times, especially if we have a violent move upward, the knee-jerk reaction is to see gold, maybe even, pull back or scale. And there's a reason for that too, and that reason is called real rates. Okay. There is such thing as a real rate. And what is a real rate? Basically, when you get a, 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 a bond, yield, and reduce the CPI, or it could be the PCE, an inflation indicator, okay, from the yield. And then what that number comes out to, if it's a positive, it will tend to affect gold. If it's positive around 3%, it tends to affect gold negatively. But, remember that for a long time, those yields have been negative until more recently. But, they've been from 2000 to 2022, the real yield, okay, which is the yield less the rate of inflation, has actually been negative. And, that is very bullish for gold. And, and the reason for that is because, at that point, owning gold is not really costing you anything. Holding the bond does. Not only that, more recently, there's all this risk associated to owning U.S. Treasuries. You get China selling, the Federal Reserve is selling. You got, the biggest buyers of the past 10, 15 years, are now selling. So that in itself, and at the same time, you have central banks buying gold. Okay. And there's a whole reason for that, that has nothing to do with the treasuries, and I was commenting with you a little bit, earlier, maybe offline, where, we see, for example, the Russian-Ukraine war. That situation, really is creating a global fragmentation. That is basically dividing the West, with the rest of the world, with people who align with, Western values and the U.S. essentially, and those who do not. And the fact that the U.S., for example, kicked the Russians out, from, their SWIFT and, from different systems, economic systems, it's pushing not only the Russians, but other outcasts to basically come forward with their own solutions and agendas, okay, with their own banks, with their own funds, so they can, develop their, themselves, and not depend on Western values. Eventually, as that other system grows and you have two or multiple systems, the only real arbiter of value is gold. Is the only thing that is really going to be, because, if you have two systems, very unlikely that, one system, maybe the U.S. is not going to have rubles, most likely, and most likely the other system is not going to have U.S. dollars, or maybe less, in a lesser amount. But they will have gold, because everybody agrees that gold has been the currency for over 5,000 years. And this is really a store of value.
Very true. Very true. And a follow-up question for you. So in this environment that we're heading into, what is your outlook for inflation? How is that looking to you?
Well, no, I think, together with the longer term, with the higher for longer rates, I think, we have higher for longer inflation as well. And, again, it's not necessarily linear. We're going to see pullbacks and, trending up, but I think that we will see, higher inflation for longer. And all these things tie into that, the global fragmenting, and, the concepts of nearshoring and friendshoring, the countries are starting to adopt. See the U.S. already in Western countries already moving away from investing, further growth in China. Of course, there's still a huge relationship there, but, the new growth, the new stuff is going elsewhere, in the other places, Latin America, those, and that shift is very inflationary. The other thing that is going to be very inflationary is because this other group that the U.S. and Western are basically moving away from control a lot of the resources globally. And so in order for Western countries to be able to use those resources and energy moving forward, they're going to have to pay a price, and it's going to be probably higher than what they've been used to so far. And again, all that is inflationary. All these things, over time, as they play out, will contribute to higher inflation for longer as well.
Okay. And, possibly throwing into the mix there, recession. I know a lot of people have concerns about whether that recession is finally going to hit us. Just want to check in with you on that too, and see where you see it.
Absolutely. So, I haven't been honestly a big, I haven't really been pushing the recession. We've been actually in the camp, that the U.S. is strong and that the dollar is strong. And we've been in this camp for the past couple of years. And, not everybody, it hasn't been a very popular stance, but it's been a very, profitable one for us, because that's really what's been happening. Now, ever since the dollar broke and has been now downtrending, and we see economic activity in the U.S. starting to scale back. We're starting to see unemployment rise a little bit. We're starting to see labor participation, scale back. We're starting to see unemployment seekers, you're starting to see things that are telling you that, okay, we may be, we may be, we may have passed the top or a peak of sorts, and it might be time to pull back, and as we see the dollar break down to lower levels, that is also very indicative of all that. Well, then of course, because in today's world, the dollar is still the reserve currency, and most assets, commodities, resources, energy is priced in US dollars. With the US dollar falls, everything else will tend to rise. And, right now, basically, my key word for this issue that I have this week, today, published tomorrow morning, is the everything right, because, the decline in the dollar, is exactly what will bring. And then again, and I think, and I'm sorry to interrupt, but I think that ties into, basically the recession. The declining dollar basically is on declining U.S. economic data, which, tell us that, yeah, we might get a recession, whether it's going to be a full-blown recession, whether it's going to be a soft landing, I think that's just seen, but for sure, a definite pullback in economic activity on the dollar, we're living it, and it's probably going to continue.
Okay. Yeah. Thank you for going over that. That's really helpful. And what's becoming really clear, and I'm sure what people already know, this is a really complex situation right now. And I think a lot of investors are wondering, okay, so how do I handle that? And I know you talked at the beginning a little bit about knowing your time horizon, at least when it comes to gold. You might be a trader, you might be an investor, but any other advice or ideas for people who are looking at this situation and trying to figure out what to do?
Well, yeah, I definitely think that, a big talk, talking more macro, I think like a big talk has been, what has happened to the 60-40 portfolio? Where are treasuries and all of this? Do I need treasuries, 40% of my portfolio? I think that one of the things that investors have to see moving forward is that if we are going to be in a 30-40 year bear market in treasuries, you don't want to have such a big exposure to treasuries. Okay. You want to be able to have that 40% of safety in your portfolio with other things, such as gold miners. If you don't want to be risky and go with the juniors, and then there are very very safe big companies that you can buy that pay dividends, that are very solid and stable with great management, great assets. And I would encourage investors and traders to actually try to fill up that portion of their portfolio that's supposed to be for safety or for treasuries. Maybe not eliminate treasuries altogether, but I would definitely, share that space with gold, with precious metals, because I think that, moving forward, they're going to be favored over the treasuries.
Yeah, I think that makes a lot of sense. And I've been hearing from other people as well that 60-40 portfolio is not really going to make sense moving forward. So really good information. I think that is kind of wrapping up all the questions that I had for you, but I'm going to put it back to you and ask you if you have any final advice for investors, especially heading into the new year, or maybe also let us know where we can find you if people want to learn more.
Absolutely. So you can go to my website. It's Gold Charts R Us, just with an R and a U, like R and a US.net. And we are a weekly trading service, and you can if you go there, you can subscribe. It's a $50 a month fee. If you email me to Ayales at aidenforecast.com, okay, that's Ayales at aidenforecast.com, I'll be more than happy to give anybody who emails me a comp, 1 month comp to my letter, so that they can see what we're all about, and they could see more of these types of correlations, these types that, every issue is full of charts, full of this type of analysis, macroeconomics, and, also we provide very specific buy and sell recommendations on a very short-term basis and medium and long-term basis. So please, join us, and I think you'll be pleasantly surprised.
Amazing. Okay. And I can include that information as well in the video description so people can check it out below if they want to see more. Thank you so much for coming on to talk about what's going on in gold and the markets. Really good to hear from you, and hope to do it again.
Anytime, Charlotte. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Omar Ayales with Gold Charts Are Us. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.